Hey everyone, welcome. So today, we're going to decode one of the most important rules in global accounting, IFRS 10. This is the standard that tells massive, complex companies how to show their finances to the world. And it's all about one thing, seeing the complete picture. Let's break down how it really works. You know, when you pick up a company's annual report, you think you're seeing its financial performance, right? But what if I told you that report might only be showing you a tiny fraction of the reality? Is it ever the whole story? Well, the truth is, for most big corporations, that single report is just one piece of a way, way bigger structure. See, modern businesses are often these intricate webs of parent companies and all the subsidiaries they own and operate. So, to really get a handle on the financial health, the risks, and the true value of a corporate group, you can't just look at one little piece. Nope, you've got to put the entire puzzle together. And that, right there, is exactly what IFRS 10 is designed to help us do. All right, so let's jump into our first section. We're going to get to the heart of the problem that IFRS 10 solves. How in the world do we get that single, unified view of a huge, sprawling corporate empire? The answer is something called Consolidated Financial Statements. IFRS 10 makes it a rule. A parent company has to combine its own financials with those of all its subsidiaries. The whole point is to present the entire group as if it were just one big company, what the standard calls a single economic entity. Okay, but how do you decide which companies to include in this big group statement? Well, that brings us to the absolute core principle of IFRS 10, and it's a major shift in thinking from the old rules. It all comes down to one simple but powerful word: control. You see, before IFRS 10 came along, the rules were often a bit too simple. They focused on a bright line test. Basically, if you owned more than 50% of the votes, you consolidated. But this created some serious loopholes. It let companies hide debt in other companies they didn't technically own, but absolutely controlled. IFRS 10 threw that out and brought in a much smarter idea. It's not just about who owns the most shares, it's about who's actually calling the shots. And here it is, the official definition of control. And I want you to notice, it's not just about power. It's really a three-part test. An investor has to have power over a company, be exposed to its financial ups and downs, or variable returns, and, this is key, be able to use that power to affect those returns. This definition is so important that the standard actually breaks it down for us into three essential elements. You can think of these as the three pillars that absolutely must be there for one company to control another. That's it, just three. So everything about control hangs on these three things, and you need all of them. As the standard lays it out, they are power over the company, exposure to its variable returns, and finally, a direct link between that power and those returns. First up, power. Now, we're not talking about just any power. It's the ability to direct the relevant activities. And what are those? They're the big decisions. Stuff like setting the budget, hiring and firing the top execs, or approving major new projects. It's about who can make the calls that really move the needle. Next, you've got variable returns. This is a fancy way of saying the investor has skin in the game. Their financial outcome actually changes based on how the subsidiary does. This could be through dividends, a rising stock price, or even management fees. And these returns can be positive, negative, or a mix of both. And the last piece of the puzzle is the link. This is the crucial connection, the glue that holds it all together. It means the investor can't just be some passive manager or an agent acting for someone else. They have to be able to use their power to directly impact their own returns. This proves they're acting as a principal, making decisions for their own benefit. Okay, so now that we have those three pillars down, let's look at how this plays out in the real world, because this is where it gets really interesting. IFRS 10 makes it clear that you can have control even without owning a majority of a company. All right, check out this scenario. It's adapted from an example right in the standard. An investor buys up 48% of the votes. The other 52% are scattered among thousands of tiny shareholders. So the investor doesn't have a majority. The question is, who's in control here? So who is it? Under IFRS 10, it's the 48% investor, hands down. And why is that? Because no other shareholder even comes close. And let's be real, it's basically impossible for all those tiny shareholders to get together and vote as a block. This gives the 48% holder what the standard calls the practical ability to win any vote they want. They have de facto power. But wait, let's flip that on its head. Look at this case. Here, investor A has 45%, which is the largest single stake. But
two other investors each hold 26%. In this situation, investor A is not in control. The reason is pretty simple. The other two investors could easily team up and outvote investor A. The path to defeating them is actually clear and pretty straightforward.
All right, so the main rule is pretty clear, right? If you have control, you consolidate. But like any good rule, there's a big exception. And it's for a very specific type of business, the investment entity. So the standard lays out three key traits for these investment entities. Think of things like a venture capital fund or mutual fund. First, it gets money from investors to provide them with investment management. Second, its whole business purpose is just to invest for growth or income. And third, it measures almost all its investments at fair value. And this is the kicker. If a company fits this description, it does not consolidate its subsidiaries. Instead, it reports them as investments measured at their current market value or fair value. Any changes in that value go straight to the income statement. And honestly, for the people investing in that fund, this is way more useful information than seeing a messy, consolidated balance sheet of a bunch of different startups.
All right, let's bring it all home and recap the big takeaways here. First, IFRS 10 totally changed the game by shifting from simple ownership to the principle of control. Second, that control stands on three pillars: power, variable returns, and the link between them. Third, this means you can have control even without a majority of the votes. And finally, the whole goal of this thing is transparency, to give us a true and fair picture of a corporate group's finances.
You know, digging into IFRS 10 really shows you just how critical these rules are for understanding our incredibly complex financial world. It kind of makes you wonder, right? What's the next big frontier for financial transparency? Is it reporting on environmental impact? Or maybe our supply chains? Or is it something else entirely that our rules just don't capture yet?